Omega Healthcare investors crushed their Q2 2026 earnings estimates by a staggering 133%. I mean, the headline EPS came in at $1.19, which just completely obliterated the 51-cent consensus estimate. And revenue hit $328.25 million, blowing past the $267 million street expectation. And that's up significantly from $282.5 million a year ago.
Yeah, and management immediately followed up those headline numbers by raising their full-year 2026 adjusted FFO guidance. So they bumped it to a range of $3.22 to $3.26 per diluted share.
Right.
Which easily clears the $3.10 consensus. Yet, despite this massive double beat on the top and bottom lines and, a dividend hike to 68 cents a share, the stock actually slipped about 1.7% to around $49 following the report.
See, that immediately sets up the central mystery for this deep dive.
Yeah.
You've got a massive earnings beat, a raised outlook, and a dividend hike. Wall Street normally throws a parade for that kind of combination.
They really do.
But instead, investors took a step back and basically hit the sell button.
So to understand why a supposedly blockbuster quarter resulted in a stock sell-off, we have to look past those headline numbers.
Exactly.
Because we're looking at a quarter that seems flawless on a terminal screen, but the mechanics driving those numbers reveal, well, a massive fundamental structural shift in the company's underlying business model.
Yeah, the market's reaction makes perfect sense once you pull apart the actual anatomy of that earnings beat. When you see a real estate investment trust deliver an EPS of $1.19 versus an expected 51 cents, the instinct is to assume the core portfolio of skilled nursing facilities is suddenly just generating cash at this unprecedented rate.
Right, like they suddenly figured out how to double their margins overnight.
Exactly. But that $1.19 figure is essentially an accounting illusion. It's an EPS sugar high, basically.
A sugar high, I like that.
Yeah, the beat was overwhelmingly driven by a massive, non-recurring $246.5 million gain on asset sales. So when you strip away that one-time windfall and just examine the sequential, underlying, recurring cash flows.
The actual rent checks being collected.
All right, the actual rent. When you look at those, they were remarkably flat.
I think we need a better way to visualize what that sugar high actually means for you as a shareholder. Because, I mean, a gain is still cash in the door, right? It is like opening your banking app and thinking you got this massive life-changing bonus at work, only to realize your spouse just sold both of your cars.
That's a great way to put it.
Right. Yes. Your bank account balance looks absolutely incredible today. The balance sheet is fantastic. But your actual recurring income from your job hasn't changed at all. And now you have to figure out how you're going to get to work tomorrow.
Yeah, you still need a car.
Exactly. Omega didn't post record numbers because their tenants were suddenly wildly more profitable. They posted those numbers because they liquidated a massive chunk of their portfolio.
And the scale of that liquidation is staggering. I mean, during the first half of 2026 alone, Omega sold off 30 facilities, bringing in $597.1 million in total consideration. Yeah. And the absolute anchor of that sell-off happened right here in the second quarter. They executed this major portfolio transaction, selling 18 CommuniCare facilities for $480 million in gross proceeds.
So if you are an investor looking at this, you are watching $500 million in income-producing real estate just walk out the door.
You are. But you also have to look at what Omega is actually doing with that cash, because this was a deliberate balance sheet deleveraging event.
Okay, so paying down debt.
Yes. They took that $480 million from the CommuniCare sale and immediately aimed it at their debt. They paid down the revolving credit facility so aggressively that the balance stood at just $6 million by the end of June.
Oh, wow. Basically zeroed out.
Basically zeroed out. For a REIT of this size, having an empty revolver means you have a remarkably clean balance sheet with maximum dry powder. But, as you pointed out with the car analogy, you still have to get to work.
Right. You still have to generate yield to pay the dividend.
Exactly. A REIT is legally required to distribute the majority of its taxable income as dividends. You cannot just hoard $500 million in a checking account. That capital has to be put back to work generating yield.
Which brings us to the capital redeployment phase, because they really did not sit on those proceeds for long at all. In Q2, they closed $126 million in new investments. And that was split between $110 million in real estate acquisitions and $16 million in loan fundings. And they actually kept that foot on the gas after the quarter closed, too.
Right, in July.
Yeah, in July, they deployed another $93 million. So we were looking at roughly $220 million put back to work almost instantly, targeting low double-digit stabilized yields.
And that pace of redeployment is critical to maintaining the dividend. But honestly, the dollars and cents of the acquisitions are actually the least interesting part of this report.
Really?
Yeah, what really matters is the nature of the assets they're buying. This redeployment isn't just about swapping out old skilled nursing facilities for new ones. Omega is using this moment of high liquidity to execute a deliberate structural reconfiguration of their entire business model.
And this is where we hit the absolute core of the Q2 report. Because starting with this quarter, Omega fundamentally changed how they communicate their business to the market.
Yes, new segments.
Right. They split their financial reporting into two completely distinct segments. The first is triple net investments, and the second is the operating portfolio. Now, for decades, Omega has been completely synonymous with that first bucket.
Yeah, the traditional triple net lease model has always been the bread and butter of healthcare REITs, and it's vital to understand the mechanics of why retail investors love it so much.
It's the ultimate hands-off approach.
Totally. Under a triple net lease, Omega owns the building, but the tenant, the operator of the skilled nursing facility, agrees to pay the rent, plus the three nets, which are the property taxes, the building insurance, and the ongoing maintenance.
So if the roof leaks, the tenant pays for it.
Exactly. If the HVAC dies, the tenant replaces it. For Omega, it is a highly predictable, hands-off revenue stream.
And to be fair, they are still executing that classic playbook. In Q2 and Q3, they spent $41 million acquiring 3 traditional triple net facilities across Indiana and Texas. And then in July, they dropped another $73 million on 6 more triple net facilities in Texas.
Right, so they haven't abandoned it.
No, the legacy model is still functioning. But the introduction of that new operating portfolio segment is a massive philosophical pivot.
It's a profound shift in risk tolerance. Just look at how they spent the rest of their capital. They deployed $58 million to acquire 4 senior housing communities in Rhode Island and Tennessee. But they did not lease them out on a triple net basis.
Right. They brought in operators.
Yeah, they brought in 2 new third-party property managers to operate the facilities under a RIDEA structure. And then in July, they spent $20 million to acquire the operating company of 4 care homes in the UK, also transitioning that investment into a RIDEA structure.
Okay, I have to stop here and push back on this, because this shift fundamentally alters the investment thesis for you as a retail shareholder.
How so?
Well, the entire historical appeal of Omega, the reason you hold this stock in a retirement account, is the low volatility predictability of the triple net lease. You sign a 15-year lease with an operator, you collect your fixed check, and you completely isolate yourself from the chaotic day-to-day operations of running a healthcare facility.
That's the traditional appeal, yes.
Right. But by shifting toward RIDEA, which is the REIT Investment Diversification and Empowerment Act, Omega is legally allowed to share in the operational profits. But they're also taking on direct operational exposure. Aren't they exposing their retail investors to the exact type of operating expense volatility that REITs are specifically designed to avoid? I mean, if labor costs for nurses spike in Rhode Island, Omega feels that immediately now.
Yeah, and that is the exact tension dragging on the stock price right now. You are entirely correct that a RIDEA structure destroys the absolute predictability of the triple net model. If nursing wages skyrocket or, if occupancy plummets during a bad flu season, Omega's cash flow takes a direct hit. The insulation is gone.
Right. So why do it?
Well, you have to view this through the lens of upside capture. The fatal flaw of the triple net lease is that it's a fixed ceiling. If an operator figures out how to run a spectacularly efficient facility and they double their profit margins, Omega doesn't see a dime of that extra success.
They just collect their fixed rent check and that's it.
Exactly.
So they are willingly trading the absolute safety of a fixed rent check for a volatile but potentially much higher piece of the actual business performance.
That is the trade-off. However, management is actively underwriting safety nets into these RIDEA deals to try and mitigate that day-to-day volatility. Take that $20 million UK acquisition as the prime example. Omega explicitly highlighted that those 4 UK care homes operate with a 2.41x trailing 12-month EBITDA coverage ratio.
Okay, let's break down what EBITDA actually means in the specific context, because it's it's arguably the most critical metric for evaluating this whole strategy.
Yeah. So EBITDA stands for earnings before interest, taxes, depreciation, amortization, and rent. It is basically the purest measure of a facility's cash-generating power at the local level.
And we add rent back into the equation, right?
Exactly. We add it back in because we are trying to figure out exactly how much cash the facility produces before it pays the landlord. So a coverage ratio of 2.41x means these UK facilities are generating nearly 2.5 times the cash needed to cover their underlying lease obligations.
That is a massive operational cushion.
It really is. It tells the market that, yes, Omega is taking on operating risk, but they are only doing so with assets that are already performing at a highly profitable, stabilized level. They aren't trying to execute operational turnarounds here. They are buying cash cows and taking a sip of the milk.
That 2.41x coverage ratio is a phenomenal defense of the strategy. But, I gotta say, it also creates a really stark contrast when we pivot to look at the rest of Omega's portfolio.
Oh, absolutely.
Because if the new RIDEA strategy is all about capturing the upside of healthy tenants, the reality is that the legacy triple net portfolio is currently drowning in localized distress. You simply cannot fully understand this corridor without looking at Genesis Healthcare.
Genesis is a towering piece of context for this stock. They're a massive legacy tenant for Omega, and in July of 2025, they officially filed for Chapter 11 bankruptcy protection.
Which is usually terrifying for a REIT.
It's a nightmare scenario. I mean, a major tenant entering Chapter 11 usually means an immediate violent disruption to cash flows and just a protracted legal fight over lease rejections.
But the Q2 update paints a surprisingly different picture, right? Because Genesis has actually made all of their contractual rent and interest payments straight through April of 2026.
They have.
Omega recognized $13.3 million in rental income from Genesis in the first half of the year alone, alongside another $18.8 million in interest income from secured term loans and debtor-in-possession financing.
And that debtor-in-possession, or DIP loan, is the crucial mechanism explaining why Omega is still collecting cash from a bankrupt tenant. Back in March of 2026, Omega agreed to provide $26.7 million in a new super priority secured DIP financing facility for Genesis.
Now, on the surface, that sounds insane to a casual observer. Your tenant goes bankrupt, so your solution is to loan them another $26 million.
I know, it sounds totally counterintuitive, but it is actually a ruthless, highly effective strategy to protect the underlying assets.
How so?
Well, when a company files for Chapter 11, they need immediate liquidity just to keep the lights on and pay the staff. If the facility is shut down and the patients are transferred out, the value of Omega's real estate drops to zero, basically overnight.
Because an empty nursing home isn't worth much.
Exactly. So by stepping in as the DIP lender, Omega provides that essential lifeline. And because DIP loans are granted super priority status by the bankruptcy court, Omega essentially cuts in line ahead of all the other creditors.
Oh, so they guarantee they get paid first.
Yes. They guarantee that Genesis can continue operating, which preserves the value of the buildings, keeps the underlying cash flowing, and places Omega in the strongest possible negotiating position during the actual restructuring.
So they're aggressively managing the Genesis fallout, but Genesis isn't an isolated incident. There's another massive fire burning in the portfolio, and that's the Maplewood overhang.
Yeah, Maplewood is tough.
Omega has this massive revolving credit facility with Maplewood with an amortized cost of $263.6 million and a staggering $335.5 million in principal outstanding. And crucially, as of this Q2 report, that massive loan sits on non-accrual status.
And that non-accrual status is really the silent killer of earnings in this report. When a loan is placed on non-accrual, it means the lender, so Omega in this case, has determined that the collection of interest is in serious doubt.
So they just stop counting it.
Exactly. Consequently, they simply stop recognizing that interest income on their financial statements. So when you have a $335 million loan suddenly stop generating recognized interest, it punches a massive hole in your earnings.
And suddenly, the flat underlying cash flows we talked about earlier make perfect sense. Omega sold $600 million worth of real estate, generating a massive accounting gain.
Yeah.
But the actual day-to-day cash flow is being dragged down to earth by this massive Maplewood non-accrual and the ongoing Genesis bankruptcy.
Exactly. The legacy portfolio has these pockets of severe distress that are actively bleeding cash flow. So the strategic puzzle for Omega's management is this. How do you offset the drag from Maplewood and Genesis while simultaneously funding a transition into these new RIDEA structures?
Right.
And the answer is aggressive dilution of risk through your healthiest operators.
Basically, you outgrow the problem.
Precisely. You just make the pie bigger. And the Q2 report highlights an expanded partnership with Sabre Healthcare as the primary vehicle for this.
Yeah, I saw that.
Omega executed $124.3 million of net investment activity with their Sabre Propco joint venture. That massive capital injection resulted in the addition of 27 facilities under Sabre's operations.
So they are leaning heavily on the winners.
Yes, by rapidly scaling up with an operator they trust, one that pays rent consistently and manages facilities really well, Omega is stacking healthy, recurring cash flows on top of their portfolio. The goal is just to make the distress at Genesis and Maplewood represent a smaller and smaller percentage of the overall pie.
Let's take a step back and just look at the sheer complexity of what we have outlined today. Omega is liquidating assets at a massive scale to deleverage the balance sheet. They are playing hardball in bankruptcy court with super priority DIP loans to protect legacy assets. They're suffering hundreds of millions in non-accrual drag from troubled tenants.
That's a lot.
And amidst all of this, they are actively pivoting their healthy acquisitions away from their historical triple net identity into operationally intensive RIDEA structures. I mean, that is a multi-front war. And managing that transition is now falling to a completely new leadership team.
Yeah, and that is the final pivotal piece of context for Q2. Because this report officially marked the 100th and final earnings call for Omega's long-tenured CEO, Taylor Pickett, and CFO, Bob Stevenson.
100 earnings calls. That is a quarter of a century at the helm of a publicly traded company. When you think about what they have navigated over the last 25 years, massive overhauls to Medicare and Medicaid reimbursement structures, the 2008 financial crisis, the absolute devastation of the skilled nursing industry during the pandemic, it is a monumental corporate milestone.
It's rare longevity, for sure, and it means the market has grown deeply accustomed to their specific strategic cadence and their risk appetite. But the execution of the succession plan is now a reality. Matthew Gourmand officially takes over as CEO on October 1st, 2026, and Neil Ballou has already assumed the role of CFO as of August 1st.
So if you are analyzing this stock today, you really have to evaluate what this new C-suite is actually inheriting. They aren't taking over some sleepy, stable utility company.
Not at all.
They're stepping into a highly active pipeline, armed with a freshly restructured balance sheet flush with Communicare proceeds. And they're tasked with executing a clear mandate to drive this operationally complex RIDEA expansion.
Yeah, so to synthesize the entire landscape of this Q2 report, Omega delivered a massive headline earnings beat. But that beat was an accounting mechanism driven heavily by asset sales. Those sales masked a reality where underlying cash flows remained stubbornly flat, heavily weighed down by localized distress with legacy tenants like Maplewood and Genesis.
Right.
But to combat this, the company is outgrowing the distress through massive partnerships with healthy operators like Sabre, while simultaneously executing a profound structural pivot into an operating portfolio segment. The underlying fundamentals of the business are solid enough to support a dividend increase, but the mechanical engine of how Omega generates its revenue is fundamentally transforming, all under the watch of a brand new executive team.
And that transformation leaves you with a critical, provocative thought to mull over as you evaluate your own portfolio. For decades, retail investors have flocked to Omega Healthcare for its reliable yield, anchored by the theoretically safe, hands-off predictability of the triple net lease model. But as Omega aggressively moves away from those pure-play roots and takes on direct operational exposure through RIDEA structures and third-party managers, you really have to ask yourself a hard question. Does this stock still belong in your safe, predictable yield bucket? Or is the market actually acting entirely rationally by demanding a higher risk premium for a company that is rapidly adopting a much more complex, operationally intensive identity?
It's the multi-million-dollar question.
It really is. But to sure you follow the show for daily earnings coverage as we continue to break down the most critical numbers on Wall Street.